I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and to look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout the show. Well, the stock market fell hard again last week as worldwide inflation soared and interest rates roared. Early week gains evaporated as Germany reported a 7.9% inflation rate. That's just month to month in August. Year over year, 45.8%. Well, a lot of that was energy, and we know there's an energy squeeze going on in Europe, but if you take out energy, it was still a 13% inflation rate. So inflation is roaring, especially in areas outside of the U.S. Many companies were downgraded by analysts or warnings from the company. For example, Ford, they warned and they talk about supply chain. They were down about 18% for the week. And of course, supply chain is just a fancy word that the government and the Fed caused malinvestment. So now we're screwed. Micron, NVIDIA, AMD, that group of semiconductors, they continue to move down very sharply. And chip prices, DRAM, are, as reported by Micron, are falling sharply. What happened to that shortage? Well, maybe there's a shortage of chips and prices are falling at the same time. Kind of weird on supply-demand situation, but they are really struggling and those stocks are getting killed. It was really a big day on Wednesday. The movement was just incredible. FOMC policy meeting was over and they came out with their statement. The market did start out on the upside, and that was despite Russia saying that they were going to take over those areas that they have now control of, and they would use nukes. If anybody tried to take them away from them. That was just, of course, horrible news. And then Powell came out, and he was actually even more hawkish than we had heard in his last speech. They raised 3/4 of a point, which we all know, but those dot plots, essentially those are the forecasts of where interest rates are going. They now have the Fed funds up towards the end of the year at 4.4%. We're at 3.5% right now. The forecast had been at 3.4, so that's actually a big increase in what the FOMC presidents of those banks now believe is going to happen. So they're likely to stay tighter for longer, they also said. And we saw the dollar move up on that day, but yields actually weirdly were down on that day, and it was kind of an odd day with massive swings. The S&P started out the day pre-opening up about 25, fell about 65 points to minus 40, then rallied 90 points to plus 50, and then fell 120 to minus 70. What a day of movement in there, and that was a very tough trading day, even with all of those moves. Thursday, well, yields exploded to the upside. We saw TNX, the 10 years, up 20 basis points. Stocks fell very hard again on Thursday. A lot of this was about the Bank of Japan. They came out and said their inflation rate was up to about 3%, and they intervened on the yen. It was their first intervention in 24 years. Well, that actually has a lot of meaning because our dollar is just incredibly strong, and it's gotten down to a level regarding the dollar yen that the Bank of Japan is finally getting nervous as those inflation numbers pick up. Of course, what they need to do is to have dollars in order to use those to buy the yen, so that is putting a huge demand on dollars, and there is a dollar shortage. We'll talk about that as we go along here. Friday, we saw UK yields soar. They're even reversing some of their tax increases or planned tax increases, and the pound got absolutely crushed. Stocks worldwide moved down sharply, and the UK said they're already in recession. Well, we know that. The only place that we're really getting a lot of denial about that is here in the US, where we've had mild contraction so far for 2 quarters in a row, but they're in recession denial. I'm going to talk in a little bit why that's going to get worse. U.S. stocks, well, they're moving down very sharply here as I'm recording this at midday. They're down about 70 points, and there is really no lift at all in those S&P 500s or these indexes, and all focusing on the dollar. The dollar got up to 112.70 and has had a huge weekend here. And as I said, foreign demand is very high for dollars, and as the dollar goes up, everything gets, all the traders and investors are focused on that, and every time that happens, there are sellers that come in literally everything. I saw a very interesting article put out by Zero Hedge, and it was entitled Debt, Why the Fed is Trapped. Well, of course, I've been talking about the trap they've been setting for themselves for years. I took 2 charts out of that article, which I believe say it all. And I think it was important that I bring those here so that you can see the conditions that are going on right now, where this economic growth had come from, and how the changing conditions now are really setting up a lot of trouble. This is the first chart I'm going to show you. Total leverage in the system that compared to the real gross domestic product here in the US. So this is government, corporation, household, margin banks, student loans. This is all of that debt that was taken on. And you can see in here the real GDP right in here, real gross domestic product down here. And look at this gap that was created in here and really started to separate here around 2000. And as the activist Fed came in and the government started spending massive amounts of money, and they're even doing that right now, then this gap between the amount of debt out there and GDP really started to expand. You can see how wide that is. Well, what that means, and we all know, that we live in a debt economy and that it takes more and more debt in order to get growth here in this economy. And that is a very sad thing, because eventually what happens is the debt contracts, and it's exponential essentially. As debt begins to contract, it will affect the economic growth more and more. So there has not been a sizable contraction in debt, as you can see, except back over here, a little bit down over here during the the financial crisis right there. So that was a look at the just huge expansion of debt and how it has brought growth. But what about real growth? What does real growth look like? This is the second chart, and I think also extremely important to look at. And you can see in here that as this line goes down, that's the economic deficit. Essentially, this is the real GDP growth, as it's reflected by how much debt it takes. And debt here grows faster than the economy. Here you can see in here the economy was growing about the same or a little faster than debt, but that ended. And again, over in this period here, especially late 1900s, 2000, as the Fed and the government created this mess that we're in right now, the debt essentially, it keeps growing, and the amount of economic growth that can come outside of the debt has collapsed. So what does that mean? I mean, right now we're in an economy that is being affected by central banks needing to change. The government and the Fed created this debt economy that we're in, but now we're in QT, and the government is acting in ways to force consumers to slow down, reduce debt, increasing interest rates and very significantly. And what that is doing, of course, is unraveling this great bubble that they created, this debt bubble that we're in. And that's why there is a risk for economic contraction that will be very severe. It takes more and more debt to get growth. And now we're going to be in a debt contraction or a huge slowdown in how much debt is created, and that means that it's very likely that there's going to be a sharp economic contraction. So if you're wondering, if you're asking why stocks are falling so hard, this is it, because they are pricing that in, and the reality of the earnings growth that analysts are expecting, well, that is insane. It's just not going to happen. And the PEs are in a contraction and earnings are going to be in a contraction. And there is still a lot of risk out there. Economic contraction is going to be a lot worse coming 23 than what they have been anticipating so far. So, while we still see this short-term risk, and we talked about last week about the capitulation that was likely coming, and here it is, we're going to see a temporary bottom ahead. They're going to start to look past this valley here and not realizing the chasm that is on the other side of it. Maybe S&Ps have another 100 or 150 or 200 points to the downside in the very short term. But then we have thought that Q4 would be a period where there would be a rebound. And we think that's still the case once this capitulation stage is over. But the worst could still be coming, and that would be probably in early 23 in that first quarter. Those of you and people writing me that believe that when this decline is over, the bear market, this sell-off is over, we enter into a new bull market. Well, that's not going to happen. And I think that those believe that are going to be sadly disappointed, and maybe for a long while. Again, Q4 could be better, but the risks, as I just told you, are extremely high. For the week, stocks down 5 to 7%, depending on what you're looking at. The Russell is the worst here at the midday period. Bonds, they're off their lows right now. 30 years still down 2 3/4 points, and the 10-year yields up about 26 basis points to 3.71. The 4 years are well over, the 2 years are well over 420. Gold market, it's down about $32 on the week. This is on the dollar strength and the everything liquidation that's going on. Silver is down 80 cents. That's still way off its lows, and that reversed last week's big upside week. Still think that one is in decent shape to be putting in a bottom here. The dollar, huge upside movement in here. It's up more than 3% on the week, and that's on that big foreign demand. Just think about it. If these countries like Japan right now have to be in a position where they're going to defend their currency, and we've seen Japan do it once, they're going to be doing it a lot more. And if they have to do that, they need dollars in order to buy yen. So that means they have to sell U.S. treasuries. They have to buy U.S. dollars. They have to do what they can to anyway to liquidate something in order to get dollars to buy yen. Other currencies are probably going to do that soon also, but Japan is way, way behind on this. So that is putting this upward pressure on the dollar. And of course, lots and lots of countries out there have a ton of debt in dollar denominations, and as that debt is getting crushed, there's demand for dollars also. So there is just this upward movement in the dollar that has got everybody panicked, and they're really focused on that. Oil continues to collapse on demand destruction, down over $6 on the week, under $80 right now, and we call this very bearish condition weeks ago, as it had a very negative pattern and a breakdown. Coming up, we have lots of great stuff in the show. RV is going to bring you a member video preview of FutureSpeak, where we do 24 different futures contracts and indexes, and he's going to bring you multiple time frame analysis in Bitcoin, which we've been negative on and still negative, and he'll show you where the projections are in there. Kate Katie does a fantastic job as she presents cycle analysis and our cycle low bottom tracker. She's going to bring you cycle analysis on natural gas and show you a bottoming in there, give you a couple of option strategies using the great option platform at Tastyworks. So she's very adept at that, and you're going to find that very interesting, especially in natural gas and the strategies that she presents. I'm going to bring you a look at the short-term view of the stock market. It's going to be a little more extensive than normal. I'm going to review the daily chart and the cycle patterns and projections, but also bring you the stock index report daily snapshot. This is what our members get every day with updates with all of our indicators in all time frames on the three indexes. Last week I said that the riskiest time is coming and a long capitulation is ahead. And here we are right now. The riskiest time is here. I'm going to show you that. And the long capitulation is underway. So lots of great stuff coming up in the markets that I'm going to show you. Those of you that are new, please go to askSlim.com, either become a free member or take the special $10 deal for level 1, which I'll show later in the show. YouTube, subscribe to the channel, click the notification bell, you know when we put videos up. Do like this video, give it a thumbs up, and on Twitter, follow us at askSlim. For any information on our memberships, anything on the analysis that we presented here, write to Matt at askSlim.com. This is a preview of a member video, and Arby is going to bring you analysis on Bitcoin. And he shows the big risks that are ahead. We were bearish on it all the way from 60,000s and pointed down to under 19,000 long before, and that's where it came down to. And now we're going to show you where the risks still are for lower prices. Arby does a great job on this. You can see the full Future Speak video, 24 futures and indexes, by becoming a level 2 or higher member. All right, Arby, show them Bitcoin.
We're going to look at this from a side-by-side view because I think it's most helpful. I'm also modify this axis here as well because I want to make sure that you can see what I'm looking at here. So Slim has added in this overall 18,000 target. We have just basically hit that target and then a possible target then below that of 13.6. That level comes in on this next corrective period, which is only due later towards the end of the year. Okay, so that's where that 13,000 target really comes into play. If we look at this chart right here on the daily, this minor cycle low form right there, then we got a rally. If you want to draw your fibs right there, you can see the levels. It fell right at that 61.8 and gave you a sharp failure. Now what's happening is we're late in this dominant cycle. As we've mentioned, late in cycles, low odds that rallies will hold. So if this were to get a little uptick here, it'll likely fail quickly and then sell off one more time with that next low due around the first week of October. That's what the highest odds are right now. So that's what we have our eyes on. In terms of our levels, we're going to draw that from the minor cycle high so we can see where we can rally up into. And that zone from around 20,000 to around 21,140, we really wouldn't want to see it through that at this point. So that zone is where we would look for this to fail, then for this to roll over one more time. As we've added in here, there are levels on the downside from 17,560 to around 16,120 or so. So that's what we'd be looking for on this last corrective move of this big dominant cycle right there. So to draw it in, little flag, failure in the zone that I mentioned, and then for this to sell off again one more time into that early part of October timing, after which we get likely another rally and then a failure again. If we look at this dominant cycle right here, that next dominant low is due ideally around 1210. That will sync up with this cycle right here, which is this black dominant cycle. That's where we see decent odds of a move down to that 13.6 if this ends up trading like we have drawn in. A sell-off right here, another little rally that then fails again, then that 13.6 is certainly on radar. So this is the overall picture here in Bitcoin, a sick market, and certainly favoring the short side still for a likely one more move down in the short term.
Great job on that. This is Katie. She's going to bring you a great lesson in cycle analysis looking at natural gas. Katie shows a bottoming condition in there, and she looks at bullish option strategies using the Tastyworks platform. And she gets great help from this, from all of the work that she does looking at our cycle low timing tracker. And she's going to give you a little peek at that also. So in this case, we're looking at a potential bullish setup and how she would approach that. So Katie, show them.
Hi, this is Katie with askSlim. You're looking at our cycle low timing tracker. It's a tool that our members use to identify possible opportunities setting up, going into, and coming out of cycle bottoming time periods of the symbols on our focus list. The cycle low timing tracker covers both the intermediate and short-term time frames. The symbol that I want to talk about today is natural gas futures /NG, found here and here on the cycle low timing tracker. Now, the first box is where we put symbols that are in their cycle timing windows, whether on the weekly chart or on the daily chart. /NG is in its cycle timing window on the weekly chart, and I'll be showing you that shortly. These colored squares next to the symbol are an at-a-glance visual indication of a combination of momentum and cycle phasing conditions in each symbol. The first square is for the intermediate term and the second square is short term. So while these are dynamic, this green square next to natural gas futures is telling us that intermediate term conditions currently are looking positive, and the yellow square is telling us that the short-term conditions are more neutral. /NG is also found over here in the In Sync box. When a symbol appears in this box, it's letting us know that the current daily cycle ends at a period of time within the weekly cycle timing window. Therefore, the daily cycle low and the weekly cycle low are expected to sync up. This situation has the potential to set up some very lucrative opportunities. Let's go over to the chart and I'll show you how this works. This is a 5-year weekly chart of natural gas futures. We have a large dominant 54-bar cycle that is broken down into minor half cycles and minor quarter cycles. Let me just trace out this latest part. Now we moved up sharply in the rising phase of this new cycle. We retraced into the minor quarter cycle, and then we moved up again. Now we're currently retracing into the minor half cycle. We have these blue vertical dashed lines that form the weekly cycle timing window. They're a period of time around this ideal cycle low, when we expect this minor half cycle and minor quarter cycle to form the low, and then for natural gas to begin moving up into this next rising phase. Now that period of time is from September 5th to October 14th. Momentum on our weekly charts is represented with our proprietary reversal scout. That's this green and purple ribbon on the chart. Notice how it's green in the rising phase here, and it turns purple shortly after the peaks form. We currently have a reversal scout that is showing negative momentum, so we would like for that to turn positive as we begin this new rising phase. So our projection is for natural gas to get up perhaps as high as this 9.5 area in the second minor half cycle as that larger, more dominant cycle begins to exert some downward. Switching over to the daily chart, we have a dominant 70-bar cycle that is broken into minor half cycles, and we are late in both of those. So we have a daily cycle timing window that is coming up between October 4th and October 13th. Those dates fit within the cycle timing window that I just spoke about on the weekly chart, and that is why /NG is found in the In Sync box on the cycle low timing tracker. Now, momentum on the daily chart is negative with both the reversal scout as well as the slim ribbon, which is another proprietary momentum indicator that turns the candles red, green, or gray, depending on momentum conditions. We'd like to see those momentum indicators begin to neutralize and turn positive as we start the rising phase of this next cycle, which corresponds to the rising phase of the second minor half cycle on the weekly chart. So what we're looking for here is for natural gas to just chop around in here or move lower into the bottom of this support zone as we make this cycle low. The bottom of the support zone is at about 7. We want to see that hold and then for natural gas to start moving back up. We would watch the lower time frames to give us some indication of the momentum shift we're looking for. Currently, both our 2-hour and 15-minute charts are showing negative momentum. Let's go over to Tastyworks quickly and see about some option strategies that we could set up. These are the available expiration cycles in natural gas futures. I'm looking at the November 25th expiration cycle because this is not a setup for right now. We're expecting the cycle low in natural gas futures in a week or two. We want to see /NG begin to move through the bottoming phases on the cycle low timing tracker and for momentum to neutralize and turn positive. So at that time, the November 25th expiration might be around 50 days to expiration point. So implied volatility is high in here. It's 100.2% with an IV rank of 64.9. That high implied volatility leads us toward short premium strategies because those strategies will benefit by a vol contraction that could come as natural gas moves higher. Looking at this option chain, the bottom of our support zone was at about 7. Now, there was also a 78.6% fib level at 6.17. However, if natural gas retraces that far, then I'd suggest being much more cautious about a long side setup. For demonstration purposes, let's say that natural gas holds the support zone above 7 and begins to move up and improve momentum on the lower time frames. We could sell a put at that 7 strike. This is showing a credit collected of 0.796. Now, since the notional on natural gas is 10,000, the credit collected is really $7,950. But this uses greater than $10,000 of buying power. If you'd prefer to use less buying power and/or you prefer a defined risk trade, you could go for a short put spread. Now, you can make the spread as wide as fits your account size and risk tolerance. For demonstration purposes, I'll buy the 6.9 strike to define the risk. That's a 10-cent wide spread. But remember that the notional is $10,000, so that means that a 10-cent wide spread is actually worth $1,000. So the credit collected here is 0.052, that's $520. Because the spread is worth $1,000, that means your max loss is the width of the spread minus the credit collected. So if your max profit is $550, your max loss is $440, and that is also going to be your capital requirement to put on the trade. So again, this is not a trade to set up today because we don't know yet how far natural gas is going to retrace into that timing window. So let's keep an eye on the natural gas chart. To follow our options trade ideas and use our cycle low timing tracker and other tools, please come visit our website at askSlim.com.
Fantastic work on that, Katie. Thank you. This is my analysis on the stock market, S&P 500. And we're going to take a look at the short-term view, looking at 1 to 3 weeks ahead on a daily chart. I'm also going to look at the stock index report. This is a daily snapshot of the 3 indexes, and I want you to see all of the information that's in there. It'll give you a great idea about the market conditions as we look in that. So this is what Matt prepared and posted for Our members, level 1, 2, 3, 4, 4 plus, all of them got this last night, getting ready to set up for today. So I will show you what that looks like and what those indicators look like in there. So I know a lot of people, they come here, they listen to what I say and scroll forward. Well, this is extensive, so you're going to want to really see all of the information that I'm going to show you, and this is going to be a relatively long segment when I present this. So let's start out by looking at the S&P 500 and daily chart. For those of you that are brand new and have never seen these charts, and of course we get many people that come and see it for the first time, we do cycle analysis. That's not psychoanalysis, it's cycle analysis. And this is how we understand the energetic movements in the market. And you've seen our analysis, those of you that have, and you understand the value of doing this in multiple time frames and also using our proprietary indicators. The indicators we have on here that you can see are the slim ribbon, which is right in here, and the slim ribbon PO, which is in the bottom, that gives you momentum conditions. So when the slim ribbon is pointing up and the three moving averages are pointing to the upside, then you have bullish conditions. And when that happens, this is green, and the bars are green, as you can see. When you get into really negative conditions, this turns red. The slim ribbon is pointing to the downside, and you have the highest probability of impulses to the downside. The later you get in a cycle condition is when you can get the capitulations on the downside. This happens to line up with the weekly, and that's when you get the biggest downsides, and that you can see right over here. Here you could see this was a really strong period there as momentum was strong, and then you got this upward resumption signal, and you can see there. On the bottom, these are cycle brackets. These are a drawing tool. These are not the cycles. The actual cycles are how we draw them here up on the top, and it's how they resolve that's what's important. When you get a rally that aborts, as this one did very early, and then broke down underneath this low, it tells us it's likely to decline all the way through this period. And we put in these yellow ovals on a lot of charts that show this is where the biggest downside risk is, and that's what we got. We were looking last week at the potential for a rally up here for a rebound, 39.36 or even a little bit higher, but it tried to rally and just gave it up. And this minor little cycle right over here almost had no rally. This is called the left-hand translation. This is a very large left-hand translation right there, which was just a big signal for the downside when it broke this level. So where are we right now? Well, we're coming into the final stages in here. Now you can see these two blue verticals right here. This is the ideal low timing range. Generally, it's 3-4 days on either side of this. Of this nested bottom right over here. So that would say maybe another couple of days in here. And we had originally, had said, we'll give the market the possibility of stopping on the downside at the 78.6 at 37.75, but really needed to come down and take out that low at 36.36. And when it was way up over here, it seemed like that was impossible that was going to happen. But here you are right now, practically getting down to that level with some number of days left ahead. Now, I want to also say that the 3 or 4 days past this ideal would just be normal. A lot of cycles are running long because there's a giant liquidation going on right now, a capitulation. What is a capitulation? It's the stages where investors and traders give up. They essentially have had it, and they sell out their positions. And then there's literally nobody left to sell, and the prices are usually down a lot when that happens. Then you get into rebounding rally periods like right out over here, but I can't put a target out over here until I know where this low is. So we just know and believe that somewhere out here in October, there's going to be a rebounding period, and that exists on the intermediate patterns also. So that's what we're looking for. A washout right in here, further downside potential, likely taking out 36.36. The next support on the weekly pattern is around 35.30, which is a Fibonacci extension level on the intermediate pattern. And that to me is an extreme. If it got down there, I think it would rebound very quickly from that level, at least now. So this is the short-term view. This is just the next few weeks that we're looking at in here, and we think that we're in the capitulation washout stage, and there could easily be another 100 points to the downside in here in just this next week, or it could tickle out that 36.36 and then be, washed out at that point and not have any really big declines after that for a while. But I really want to talk about the conditions of the market right now because that's really important to this analysis. And we share those market conditions with our members in the SIR daily snapshot, stock index report daily snapshot. And I want to show you that because I'm just showing you short-term analysis right now, but it's really important to understand the conditions in the market. So I'm here at the askSlim website that you can see right there. And what we're looking at is the daily snapshot. This was for the close yesterday on 9/22. And I'm going to take you through this and you'll be able to see what we shared with our members so that you really understand. There's some little tips in here on the top for our members. We have a lot of members that may not have really looked at that extensively, so I thought I would go through it. So this is it starts out with technical summaries for the S&P 500, Nasdaq, Russell. I'm not going to go through all of this, but you get the idea. This is updated all of the time, and it gives you the conditions. You can see bearish right there, all of the important numbers for the Nasdaq, the S&P 500, Nasdaq, and the Russell. So I'm just going to stop it right here so that you can get a little screenshot if you want of this and take a look at that. Of course, our members get the updates on this every single day. So that's the technical summaries that are in there. It's not really what I wanted to show you. This is the askSlim charts right there. So the chart that is really important for short-term traders is the 2-hour with the slim ribbon indicator, and that's pointing down right over here, and you could see the slim ribbon PO on the bottom. These are negative. You can see the negative resumption signals in there. So the 2-hour pattern is very important for short-term traders, and all of the information is in here, support, resistance, and this was quite negative and exists in a very negative condition right now. Now, that is the 2-hour chart for the S&P 500. I'm only looking at the S&P 500 right now because it'll take a long time to go through all of the other ones. This is the chart I just showed you on the daily chart. So this was delivered last night. It just does not have today's bar in there. And you could see it pointing down to that 36.36 area right there, that red arrow, where it was likely to be going down to. Now, this is the weekly chart that a lot of people ask me for when I do this for the market week. We put it up there for free. So we don't give you weekly and daily normally. We just give you one or the other. We don't give you all of the indexes either. So you can see in here, we're in this area of capitulation, this yellow zone right here. You could see it was yellow here, fell, yellow oval here, fell, and we said it would happen here too. Here you could see the reversal scout where it turned negative there, and then you had a solid month to the downside and getting into this period of a potential bottoming. And as you can see, we're projecting after it makes the low somewhere down over here, it will be coming up and getting this rebound in the fourth quarter as we believe that would happen, but then a lot of risk out over here in February, March of next year. So this is why I said in the beginning of the show, if you're looking for this big decline to be the beginning of a new bull market after that, well, I think you're going to be sadly disappointed. I think this would just be the bottom of this downside leg. So that's what you get when you look at the charts. Now, if you go to the short-term outlook right over here, you can see in here that what we're looking at is the trend and momentum technical evidence. So you get the pattern structure, the slim ribbon momentum condition, reversal scout, all of those for the daily right over here and for the intraday right here, and you get a good idea as to what the conditions are right now. You can see in here that the short-term last change was September 8th when it became negative. The slim ribbon was August 31st. So these have been quite negative and giving you a warning way out over there. Let's take a look at the intermediate outlook, which is 1 to 2 months, and you can see the same thing, really looking quite negative. And these, you're going to need to get some very significant changes in the momentum conditions in order to be getting this fourth quarter rally that we think is going to happen, this rebound. So you're going to need to get some really good rebounds that happen to get that to change for that 1 to 2 month outlook. And the 3 to 6 month outlook, which weighs heavily on the markets, looking at the monthly charts, are extremely negative in here. The momentum condition turned negative back on May 6th, as you can see. So that's really a negative condition that exists in the long term that will prevent any real big upside moves in the markets. So this is the Nasdaq. I could give you the same three things on this special daily stock index report we do, and the same thing for the Russell. It's all there. I just don't want to spend another half hour going through all of those. Let's take a look at the technical evidence comparisons, and these are important. So this takes a look at the momentum conditions in the S&P 500, the Nasdaq, and the Russell. It gives you the long term, the intermediate term, the short term, and the near term, which is the intraday. And you can see in here, it is bearish across the board. And it has been that way for a long time. And our members essentially can see this. And what will happen as you start to get rebounds is that the near term will begin to change first. And if it's strong enough, it will then affect, like a domino effect, getting into the short term here. And these will begin to get better. Well, right now, they look pretty horrible, as you can see. Let's take a look at the 2-hour intraday momentum conditions that you can see. And look, this turned negative on these 2-hour charts, and you can see when the slim ribbon went negative. And here is our MCI, our market condition indicator. And when it comes up into the swing zone between 25 and minus 25, and then gets back under minus 25, that is a very negative condition. And these are really negative, as you can see right there. So everything that we have had has been telling our members about the conditions being quite negative and setting up this capitulation that we have been in. Here is the cycle analysis table in there, and this gives you all of the information about the weekly cycle patterns, the phasing that we're in, and what the ideal timing is, where the bottom timings are projected, and giving you both for the weekly and the daily structure in there. This weekly and the daily cycle structures are negative, and they've been that way for a while, and really have set up this big decline that we're in the stock market. You can see this negative configuration confirmed on August 26th, and then you got this big decline. And the projected range for the lows for the cycles were somewhere out here 921 to 929, and you can see that's what I've been telling you. And this projection has been there for a while. So I really wanted to show you this amazing report that is put out every single day by Matt. He does just phenomenal work, and of course, cycle analyst, and has a great handle on all of these things that we offer right here. And I really would, like you to be able to get that, and to be able to, here's the daily chart I just showed you. Normally, when people get that and want to sign up for level 1, they only pay $19.95 a month. I mean, it's just incredible. And what we're offering right now is a special so that you can get all of that and take a peek at it. So you'll get the first month for just $10. You can get all of these things I just showed you, the stock index report with all the analysis on the 3 indexes, with all of the cycle charts on there, projections and key levels. Additionally, for those that have longer term perspectives, you'll get our Slimulator Momentum Tracker. That's 1,000+ symbols and groups with our built-in algorithms, and that gives you the directional bias. You can also go to every week, you're going to get our SPDR, that's the Spider Select ETF weekly review with important market sectors, and great resources that we have in there for trade planning with our worksheets, and access to our Discord server for support. We have just massive use on our Discord server, and our analysts are always in there helping everybody. You can get that for $10 for the next month, and then you could cancel it anytime. You don't like it, you don't want to spend money after that, I get it. Take a look though. Click the Learn More button on the top of the front page at askSlim, excuse me, and you will then be able to see everything that I showed you in there. That is level 1 for $10. Imagine that. Do that to support yourself. Do that to support us if you watch our show every single week. I want you to go to askSlim, explore, subscribe, share, follow. If you're new, don't miss that level 1 special. On YouTube, click that channel and subscribe, like this video, give it a thumbs up, and watch our member videos in the playlists. Twitter, follow us at askSlim, excuse me, and anything that you need, write Matt at askSlim.com. I want you to be so incredibly careful. It is so crazy out there. I'm always wishing you great trading.